Hey everybody, and welcome back for the first video of Chapter 6. In this chapter, we're going to be talking about stocks and the stock market. And today, we're going to start off the conversation with talking about some basics about what stocks are and how they're traded. And then we're going to talk about stock market performance and its implication on the US economy. So, first, many of us know that a corporation is a business which provides limited liability. What does that actually mean? Well, limited liability protects owners of a corporation from losing more than they have invested for a firm. And that's really important because it means that the shareholders of a corporation can't be held liable if a company goes bankrupt. So, if I held stock in Sears and Sears goes bankrupt, the debtors cannot hold me as a stockholder liable to pay off the debt that Sears has. And so it protects the owners just from getting sued and any sort of wrongdoing that the company may do. And these limited liability corporations usually have a board of directors. They have a CEO, a COO, or a chief operating officer, and a CFO as chief financial officer, and etc. And many of them pay out dividends quarterly. Now, we're going to hear this referred to a couple times, but there's two typical classes of stock. You have preferred stockholders and then you have common stock. And preferred stock are like the special stakeholders. These are people that have like voting rights and have real control over the corporation. And so they get usually two rounds of dividends payouts. The first round to the preferred stockholders, and then the second round to the common stockholders. And when we trade on the stock markets, we're usually trading in common stock. Additionally, we're going to hear this referred to a lot, so it's really important that you understand this formula. The total market capitalization is considered to be the total value of a corporation's issued stock. And we calculate it pretty simply. It's just by taking the number of shares outstanding times the trade price. So, for example, if a company has 6 million shares outstanding and it's trading at $100 a share. We can just move over the decimal spot 2 zeros, and the company is worth $600 million. So not too bad right there. Now, about 4,400 corporations in the US are currently considered publicly traded companies. And that just means that they sell stock in the US stock market. And all the rest, all the millions, it's somewhere near 6 million companies, and obviously it changes, they're all private. And so, for example, when you think of private, if you guys have seen the show Shark Tank, all those companies on Shark Tank are private firms, and they are still sharing or selling their equity to the sharks. So when they buy, 40% of the company, they're still buying equity in the same way that you buy equity on the stock market. The difference is that the equity is decentralized on the stock market on the common stock, and so the company has really no control about who is getting the common stock. And just as a reminder, a stock exchange is just the physical location where stocks can be bought and sold, and it's always on a trading floor when you hear about formally the stock exchange. Now, the definitions have come a little bit more blurred over time as we get more digitized, but usually internet transactions are technically termed as over-the-counter transactions. And then the stock market index, for those of you that have heard it referred to before, is an average of stock prices that investors use to measure the overall performance of the stock market. So the three big ones in the United States that we hear about a lot are the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. So they're all different and they all actually indicate different things. The Dow Jones Industrial Average is just the 30 of the largest companies in the US. So we're talking like Disney, Amazon, Apple, etc. So just the 30 largest ones. The S&P 500 is all companies with a market cap of greater than $5 billion. Finally, the Nasdaq Composite has these same firms, but they also have more small tech-based companies. So if you want to like track how like the tech market is doing, you may be more interested in the Nasdaq Composite. And if you're just interested in how the big boys are doing, you might want to look at the Dow Jones Industrial Average. And pictured below are the three indexes since 2005. And you can see that they move, pretty much in unison. However, there are subtle differences. For example, as I mentioned, with the NASDAQ composite, it's more tech-based companies. And if you look at the COVID recession, you can see that it spiked back a lot quicker than either the Dow Jones or the S&P 500. And that's just because it's weighted more heavily with tech-based companies who performed and rebounded much better than the rest of the economy during COVID. So there are these nuances that detailed investors find quite important. Now, this is the big question that a lot of politicians especially like to argue, which is, does the performance of the stock market matter to the economy? Well, it does matter in three ways. First, it changes the cost of equity funding for firms. So, for example, what I mean by that is that if you go back to chapter 5, a lot of companies like to issue debt to raise money. However, they can also raise money by selling equity of the company. So if they sell more stock, people are going to buy that stock and they can artificially raise their market cap. And so they can do that and get more money. So when their stock price drops, the people in the company cannot get as much money through equity funding to fund new projects. So these big companies, you think of like Disney and all the people that they employ, they can't afford new projects quite as easily. Additionally, a lot of household wealth is now anchored with the stock market. We're talking, most people have some sort of investment stake in the stock market. It's especially important for retirement accounts that is, you're talking like pension funds that are really anchored in market movement. And then finally, it also actually changes consumer patterns in households and firms. So while there aren't perfect correlations between the two, if the stock market goes down, typically that makes households and firms more leery about, an economic recession. And so it's actually going to change the consumer expectations within the economy, speeding up the onset of the worried about recession. So it's a little bit of, you know, destiny, you can say, when the stock market predicts recessions because it tells people that a recession is going to happen, thus causing the recession to occur. So it's a bit of a weird logic, but it's not a perfect indicator. In particular, it doesn't necessarily equate to the speed of growth of an economy. It can indicate pretty well, though, when we're in a recession. And so, looking in front of you now to wrap up this video, you can see on the top, I have tracked the S&P 500 since 28 or the beginning of 2019, and then I've tracked the U.S. GDP over the same time period. And so you can see that they are pretty similar. Now, note that uh, the US GDP actually started slowing down at the beginning of 2020 more quickly than the S&P 500 because international trade slowed as COVID broke out in like China and then in Europe, whereas the S&P 500 continued going up. Additionally, if you are tracking, on the bottom of your screen, you can see that the S&P 500 reached pre-pandemic levels in about September, whereas the US economy didn't reach it until the new year. So they're not one for one, they're not perfect predictors of each other, but they do track each other quite well.